Well, hello, everyone. My name is Bill Even. I'm the CEO at the National Pork Board located here in Des Moines, Iowa. And we're here today to talk about the March 2023 USDA Hogs and Pigs report. We're going to have a recap from some economists and get the information back out to you on where we see this taking our industry for the next quarter. So in the next slide, happy to have three really distinguished panelists here joining us at the Pork Board today. First is Dr. Steve Meyer, who's the lead economist at Partners for Production Agriculture. Next, we'll be hearing from Katelyn McCullock at the Livestock Marketing Information Center, and she's a senior economist there. And then chief economist with the Steiner Consulting Group, Altin Kalo, Altin. And from that, on the next slide, we want to get started here. Certainly the antitrust statement, the National Pork Board does follow the Sherman Act to make sure that when we do bring together information related to the markets or bring together competitors, that we are ensuring that we do not violate any antitrust laws. So on the next slide, just a little bit of information about this webinar. Pork Checkoff funds are being used to host this webinar, and the purpose is to facilitate your understanding of publicly available information from the USDA. We believe that the pork industry, producers, and ultimately consumers are going to benefit from a better understanding of the economics of pork production. And the views expressed by our guest speakers are theirs and not those of the National Pork Board, which does not advocate or endorse any particular production or marketing directions. So with that, we're going to go ahead and get started, and we'll go to the next slide, and I'm going to turn it over to Dr. Steve Meyer, USDA Quarterly Hogs and Pigs Report, to show us the numbers and what we've got there. Steve.
Thanks, Bill. Good morning, everybody. I'm just going to run through these numbers pretty quick, and I'm not, you guys can read numbers as well as I can, so I'm not going to read them off. I guess I'm going to just mention a few highlights that I think we'll be discussing here this morning. Number one is that the inventory numbers came in quite close to what was expected before the report, as represented by the Urner Barry pre-report estimates that's shown in this table. Not a lot of deviation there. The big deviation was in the 180 pound and over category. And frankly, I have no idea where the analysts on the pre-report survey came up with their numbers. We've been slaughtering quite a few more hogs over the last month, and that should go with the 180 and over. And actually, the USDA number does fit pretty well. So that deviation is on the pre-report survey, not on USDA. We think that there's some important numbers in here. Most notable, we didn't grow the breeding herd at all from December. In fact, we took it down about 27,000, a slight increase from last year. But that's kind of all. All hogs and pigs up 0.3%, market herd the same. We think that's a pretty measured change at the present time, but I'll talk later about producers are looking at a very negative profit outlook for the next year. And so just hanging in there on these inventory numbers is kind of a not a surprise, but certainly it says we haven't started adjusting in the face of that yet. There are four numbers that I'm going to focus on. Two of them are the March, May intentions numbers and the June, August intentions numbers, and those are down 1.2 and 2.9%, and those are large declines given a breeding herd that's slightly larger. So we're kind of scratching our heads on those. We don't have a lot of explanation for it. The next one would be pigs saved per litter up 0.7%. That's a little faster than we've been growing recently, but still way below the pre-COVID growth rates that we saw on litter sizes. And we have much more genetic potential out there to produce pigs than what's shown by that 11.02. We've obviously been fighting disease and we've fought labor problems that have impacted that, but this might be kind of a return to those growth rates. And the final one I'll point out is the discrepancy between the year-over-year number for 180 and over and 120 to 179. 102.1 down to 99.9 is an awfully abrupt change in an inventory category. And we probably won't see that kind of abrupt change in slaughter when we get to the third week of April, when we kind of move out of those 180 and overs into the next category. So generally, and I'll defer to the other analysts as well, Our take on this was neutral to possibly a little bullish in the long term. We're scratching our head over, whether we agree with the report or not, and you always have to make that call at some point as an analyst. But we think there are some numbers here that are a little iffy. So, Bill, I'll leave it at that, and we'll let the two smarter people discuss these numbers.
Thanks very much for that overview. And on the next slide, we'll kick it over to Katelyn and talk a bit about your analysis. Katelyn?
Well, thank you, Bill. I thought one of the more interesting things in the report were some of the revisions that USDA NASS ended up doing. So you see some fairly large revisions to the December 1 report, all hogs and pigs, about a 1.2 million head revision upwards. And then also adjustments to the September and December pig crop, up about 500,000 pigs or so. And then most of those revisions came from those market hog categories. Now, revisions happen during every hogs and pigs report. Probably the key thing to point out here is how large those revisions are. And I put what USDA NASS says the average revision there is from the initial estimate to the final. So again, these aren't final yet. This is the current revision to the current estimate. So some interesting things there. Now, if you move to the next slide, we can see some of the impacts those had on prices moving forward. Now, when we were in this time period, we were wondering why these feeder pig prices maybe were a little bit lower based on what hogs and pigs said in December. But once we saw these revisions, this price profile starts to make a little bit more sense. Now, if you move to the next slide, we've also seen this match quite a bit better with what we've seen with farrow and gilt slaughter. We're up about 360,000 head year to date. That's that blue line right there. And Steve mentioned a little bit in the market hog categories, probably that 180 pounds and over 2% above a year ago. And so what that means to us is that we're expecting hog slaughter to remain above a year ago, at least in the near term. And then some of those lighter farrowing intentions are going to come to fruition later in the year. But if you move to the next slide, I think the price impact here is pretty clear so far, that we have more hogs on the market than maybe we're anticipating. And based on what that supply picture that the report painted, that at least in the near term, you're going to need some help from the demand side, at least in heading into 4th of July, to really get this base hog price up.
Thanks, Katelyn. And we'll flip over to the next slide and have Altin come in and talk a little bit about what he's seeing in the key report numbers. So Altin, if you would hop on camera, we'll hear from you.
This hog market reminds me of this Boston traffic. Just the moment you think that you're probably going to start to pick up a little bit of speed, the guy in front of you stops and you have to slam on your brakes. And I think that's kind of what these producers are doing. If we can go to the slide that shows the breeding herd, we basically had no growth in this breeding herd since the start of COVID. The profitability has been up and down, but there's been also a fair amount of uncertainty. And so that's kept the breeding herd in check. If we can go to the next slide, what we've seen though is that we've seen a bit of a shift as to where the breeding herd is. We've seen compared to a year ago, the sow inventory in Illinois, Indiana, Missouri, and South Dakota, those 4 states, increasing by about 135,000 head, while the inventory in Minnesota, Nebraska, and Utah down by about 125,000 head. If we can go to the next slide, Steve mentioned the change in the breeding herd and the farrowings. What we've noticed on the breeding herd is that the producers are basically in a maintenance phase at this point. Gilt retention, at least implied gilt retention for the quarter, was up about 2.2%. When we look at the farrowings in the next slide, the thing I always keep an eye on is how do those farrowings match up with where the breeding herd is currently estimated. And you can see that for that March, May, farrowings relative to what the breeding herd was on March 1, the numbers are a little bit lower than where you would expect. Now, we've been trending down, And so it's possible that we may see those farrowings do what the producers are saying. But to Steve's point, you have to look at those with some skepticism for now and see if they're going to go through with the intentions that they're currently showing in the survey. If we go to the next slide, the other part of it is the productivity measures as far as the pigs per litter. There's been no growth. We've had 3 years. You look at where we were at the beginning of 2020, the pigs saved per litter were about 11.09. In this latest survey, they were 11.02. So to Steve's point earlier, yes, there is some potential, from the genetics, but that's only one leg of the stool. The other leg is labor and the ability to have proper staffing that allows you to increase productivity and also to have the some relief from disease pressures that we've experienced up to this point. I'll just pass it on to you, Kristen, and I've got a couple more slides in there, but we'll probably have a little bit more of a discussion and we can reference those.
All right, thanks very much, Altin. I'd like to shift gears here, and certainly for those folks joining us here today, feel free to go to the bottom. If you've got questions, feel free to go to the Q&A box and type them in the chat, and we'll get those answered as well. But we're going to start off maybe going back to all three of the folks here around. I want to start with Katelyn and talk about, how is this report used by the industry? And Katelyn, be interested in making sure everybody's got a firm background for that. Katelyn?
Thanks. So the quarterly Hogs and Pigs report, as you might guess, is released quarterly, and the goal is to provide an estimate in time, and those numbers are reflective as of a specific date. So there's 4 reports, and they reflect March 1, September 1, December 1, and June 1st. And so the report we have here today surveyed about 4,500 producers, and that information is all in the back of the report. And what they're asked to provide is on that date, estimates for the breeding herd, total market hogs by weight group, pig crop, farrowings, as well as some farrowing intentions for what they're expecting to breed in subsequent quarters. Now, what that tells us once we get that information is it provides a snapshot of where the industry is at. And that can tell us in farrowing intentions, maybe how optimistic or pessimistic producers are feeling about the short and medium term. It also provides some evidence on how sow productivity has gone, and it can provide evidence on if, anecdotal disease pressure, how widespread it is, if we're seeing, some trouble in those areas. And that can be pretty important, is particularly in a volatile marketing environment where that delay between when the report is released and when they were surveyed, those intentions can change as well. And so decisions can change from the report. And this provides just one piece of information of maybe what to expect. March 1 is probably a great example. We've had quite a bit of change, at least on the futures market, since this report was asked for on March 1. Now, how we use it as analysts is we are trying to forecast subsequent quarters based on those farrowing intentions, as well as make revisions to the current quarter based on the revisions we saw in hogs and pigs. So I mentioned earlier that, slaughter, matching that up with December 1, this provides that new information of how to think about where prices should go from here, both on the live animal side and what to expect from pork supplies. Now, producers might use this a little bit differently. They might change their decisions based on what the report said other people are thinking of doing. Maybe they're thinking of increasing their breeding herd or cutting back, depending on kind of how many market hogs are out there or what those farrowing intentions are.
Thanks, Katelyn. And now I'm going to circle back around with all three of you in the following order. Going to start with Steve and then Katelyn, then Altin. But if you want to just comment on what's your biggest takeaways from the report. And Steve, I'll go ahead and start with you. What's your biggest takeaway from this report? You're on mute, Dr. Meyer.
Some people would prefer it that way. My biggest takeaway of this report is that it's kind of the status quo as far as the breeding herd. That there's probably some reflection of less disease pressure in this quarterly pigs per litter number, and that's borne out by the data from the University of Minnesota and others that we're dealing with less disease pressure. It also tells us that at least for the near term, we're going to have more hogs than what we thought. So I guess it was about as I expected. I'm not too surprised by anything in there. I don't think we're getting much information that's useful from those farrowing intentions because they just don't fit. So I guess that would be my reaction, the initial reaction to the report. It didn't change my slaughter forecast dramatically. It did lower them in the second and third quarter, which increased a little bit of the price forecast.
Thanks, Steve. So next, go to Katelyn. What's your biggest takeaway from this report?
I largely agree with Dr. Meyer. I think most of the numbers were pretty close to what we were expecting, particularly in the total inventory, breeding, and market hog categories. I think probably what gave me pause, and Dr. Meyer alluded to it, was those varying intentions, quite a bit lower than maybe we were expecting, at least as of March 1. Now, if we don't see some price increases this summer, maybe producers are looking at continued lower profitability or negative returns moving forward, and those might come to fruition. But I think it's more of a let's keep an eye on what those headwinds are looking like and see if we can get a few more farrowings in there from where the intentions are estimated at. And it's a little bit of a moving target at this point.
Thanks, Katelyn. So Altin, what's your biggest takeaway from the report?
Well, I guess, adding to what Steve and Katelyn said, to me, we can decide whether we want to believe the intentions or not. But in my mind, there's still evidence of what the sentiment is out there. And it seems to me, at least the takeaway for me was that we have switched from cautious optimism among producers last year, especially through the spring and the summer of last year, to a more pessimistic outlook for the future. It's reflected a little bit when we see the revisions that are made to those farrowing estimates. One thing I'd point out, for instance, is that that June, August of last year, that initial estimates, from producers were that we're going to have a lower farrowings for that period. We ended up with more farrowings. So the producers, as they saw the profitability improved, they had, it had an impact on their production decisions. And then now we're seeing a switch, and it's reflected in the March estimates, which are lower than what was presented in the previous report, and especially so in that initial estimates for June, August of this year, which is now 2.9% lower than it was a year ago. So certainly the sentiment there has shifted. Whether that will be reflected in the actual numbers that are going to come to market, that remains to be seen.
Bill, can I interject one item here?
Yeah, absolutely, Steve.
I wouldn't be a good economist if I didn't say on the other hand. So if we look at these farrowing intentions, on the other hand, the farrowing intentions might be right. There may be intentions out there to cut the sow herd from the March 1 level. That's possible, especially given the profit outlook we have right now. There might be producers that reported let's say they were average and they were 0.5% larger than a year ago, but their intentions are to reduce that sow herd and reduce their farrowings in the summer quarter, in the summer. That is a possibility. And I think the thing to watch on that will be what the level of sow slaughter is over the next 6 to 8 weeks, and whether that liquidation, we can see that in the sow slaughter numbers. So that, I kind of fall on compare everything to the breeding herd. And in this climate with a very negative profit outlook, maybe the farrowing intentions are the right yardstick and the others are going to come to meet it. That's a possibility. The key will be sow slaughter.
Yeah. Thanks, Steve. Katelyn?
And can I piggyback off of that? One thing that was kind of interesting to me as well was what states said they had an increase in breeding herd. And it tended to be, at least looking at the report, that it's really from the smaller hog producing states. And so we're not seeing huge increases in states like Iowa, and that might matter to some degree in subsequent quarters.
Katelyn, I'm gonna throw something in here for the media. We have a lot of clients across the Midwest. We have no idea where there's 70,000 more hogs in Illinois. Okay. We cannot find, we don't know where any of those are. And this might be one of those things where some sow units traded hands to a company based in Illinois and they got assigned to Illinois when they're really not there. I don't know that. But I just want to point out that 70,000 head in sows, and they had 60,000 head more in Illinois in the last report. And we don't know where any of those are. I mean, we had a pretty good discussion on our staff, and we got quite a few eyes out there. So I just want to point out, the state data is tough.
Thanks, Steve. And Altin, care to chime in here on this topic?
Yeah, I guess Steve mentioned sow slaughter and something to watch, but one thing to also keep in mind when we look at that sow slaughter numbers, that it does include some of the Canadian data that comes in, or the Canadian sows and boars that are coming in. And last year, the first 2 quarters of the year, we had a significant increase in sow and boar imports from Canada. And so that does impact the slaughter numbers. In my mind, and it's something that it's going to be really hard to see because we don't have weekly or monthly data, is what the gilt retention is. One of those things that we can only see in the rear view. And I think that's where some of those production decisions are going to come from. It's what the producers do in the next several months in terms of retaining gilts. And we saw that in 2021 when the productivity or the outlook was pretty dire, that they cut back pretty hard. And so to Steve's point earlier, they may do that again, especially when the break evens are where they are right now.
Thanks, Alton. And maybe Steve, we mentioned the cost structure out there right now, and the red ink that's in the industry right now with our producers. I want to talk a little bit around those implications. We mentioned disease PRRS. I know when I'm out on the road, there's that ongoing chronic endemic issue out there. What's your observations from your firm?
Well, Kristen, if you'll move to that cost of production slide that we have down there, let's talk about this for a little bit. Keep going. There it is right there. This is the cost of production model that I use, and it's based on, the red line would be the average cost of production from the Iowa State University cost and returns system that's now done by Dr. Lee Schultz. The green line is a forecast of that, or just a regression analysis back on corn and soybean meal prices, projecting those costs out into the future. And so you can see we've had a major increase here, and I didn't put the profitability one in here, but with the sell-off in the lean hogs futures recently, we've taken the profitability down dramatically. You can see last year's cost for this model is $95, and we think that this model is $6 to $8 below the average. So the average producer would be over $1 a pound. Very little respite in 2023. I think if you went back to 2022 and tried to look in the minds of producers, they were saying, well, golly, these costs are high, but we're just a good corn crop away from having lower costs. Well, we didn't have a great corn crop, but we didn't have a bad one. And then Argentina comes in with a lousy soybean crop this year. And so, but the whole thing on this cost deal, it's built on demand for soybean oil for biofuels, okay, and what's going on there, and that ain't going away. And so, where producers in 2021 on this model made $21 a head, last year they made $4.50 a head, and right now this model has given us minus 17 for this year, okay? So the cost of production thing is a big deal. I've told a lot of audiences that we might get production costs back down into the 80s, but I would very seriously doubt that we're going to see a number starting with a 7, unless it's on very short term. So this, this cost situation is high, and in the long run, you have to have prices that cover costs. The last 2 years, we had strong, strong prices because of exceptional pork demand. We just got lucky. All right. To get prices to cover costs, you have to go through a period of loss where you cut back output and push that price back up. And we may be kind of getting into that at this point, is what we're looking at. But by the way, we're kind of light green on the futures trade this morning. The distance are up over a little a little over $1. So this thing is turning out to be slightly bullish. I mean, that's kind of what we thought it was going to be, at least in early trading here today. But the cost of production thing, folks, is a sea change, a paradigm shift. You know, we use that term too much, but we now will have record costs of breaking the old record of 89.51 there back in 2013 for 2 years in a row, and we're going to stay probably in this stratosphere. So it's going to exert some real pressure on producers here in 2023.
Yeah, thanks, Steve, and thanks for sharing this information from Iowa State University on those break-even costs. Any comment on the endemic disease pressure that we're seeing and feeling out there in the industry as well? I know we had a little bit of comment from the panel here today.
It's better. It's better than it was. I think that is the feeling across the board. It really started getting better last summer. But it is certainly better. If we look at the University of Minnesota sample of sow farms, which covers about 3 million sows, roughly half of the breeding herd in the United States, the incidence of PRRS breaks since July 1 is the lowest on record. Okay, only about 12% of those sow farms have broke. Now, that only measures incidence. It doesn't measure severity, and we still know that, especially with the 144 strain, this PRRS is still pretty severe when it hits. But the track record of PRRS is a new strain comes along, it's awful for the first year, it's bad the second year, and by the third year, we're kind of getting some immunities. You know, we start getting a little defensive mechanism built up, and we're in the third year on this strain. All right, so that's a positive. We think that's going to get better, and we're hearing such out in the field that PRRS has gotten less. PEDV pops up every now and then. It's not something that's endemic everywhere. It's not near as widespread as when it broke back in 2013. So we see that a little bit. And we had some, I think it was mycoplasma that popped up in Iowa a year ago. That was a pretty unusual circumstance. So I think we're moving the general health level of the U.S. breeding herd and market herd back toward a good spot. It's not great yet, but it isn't as bad as it was a year ago. So that's one of the reasons we think we're going to have some more productivity. And so if you maintain a sow herd and you add 1% to litter sizes all the time, you get 1% more pigs just out of productivity growth. And going back to Altin's chart of pigs per litter, I mean, there was a time we were growing on average about 1.7% per year, and then 1.3%, and then the last 4 years we've been flat.
Thanks, Steve. I know the Pork Checkoff is doing some work with the USDA, a multi-year work on pig survivability. And both our board of directors and the board of directors from the National Pork Producers Council have flagged this, I would say, endemic disease issue, and I would say biosecurity for the U.S. pork system, which includes the farms, but then everything else in it is certainly on the radar as well. So open it back up for all of our economists here now, and for any of our guests that are on the line here, if you want to ask a question to any of our economists, please go to the bottom of the screen. There's a Q&A button down there that you can click on and just type in any questions you have in the chat. One of the other things while we wait on that for a second is in this area of exports. And I know you folks are focused on the domestic supply side and so forth, but Mexico has been a really strong market for hams, helping support the cutout here in the past, well, literally a couple of years, as we see the continued geopolitical tension with China and those as potential market. Interested in any thoughts from any of you folks, maybe Steve and others, around what you see on the export side of the equation and how is that playing out for the decision making here in the U.S.?
Well, I guess I'm the only one on camera, so I'll go first. We're guardedly optimistic about exports this year. Lower U.S. prices will make us, pork prices will make us more competitive in those markets. No question, the Europeans are really fighting an uphill battle right now. They're cutting back their supply in response to high cost and a lot of social and political pressure in some places. And so we don't think they're going to have as much product available. We work pretty closely with Brett Stewart at Global Agri-Trends, and he's got our U.S. exports up a short 3% for this year. Aaron Bohr at USMEF has exports up 5%. I always say those two forgot more about trade than I know, and so I would tend to defer to them. So we think there's going to be some growth. We're not going to make up for what we lost last year. Mexico still looks very good. They still have some production problems there that's going to keep them in our market. Now, they are bringing in some product from Brazil now that will make a dent in that. I don't think it's going to be huge, but the situation with Europe going to Asia should leave us some opportunities in Japan and the Philippines and some other places to grow. I am not a China optimist, folks. I just don't. I don't think. Number one is we still have a 25% punitive tariff on our product going in there. So when you add them all up, you got to add 40% to our prices going in there. And number two is, I don't know if you've noticed, but the relationships between our two countries are not exactly good. And so they're not going to be real gung-ho. We think most of what they've been importing over the last year and a half from us is basically byproducts, offal products. And so that'll probably continue, but we think we're going to get a little growth here, and a slightly weaker dollar helps. It's not back down to the range it was before the run-up in the dollar last year. And the value of the dollar is pretty much an index of how scared people are in the world. The Ukraine thing caused that to go up, and it hadn't gone away yet. And so we're guardedly optimistic on exports. But with that said, we're not going to start shipping. We're not going to run our exports back up to 25-26% of our production this year. We're still going to be in the 23 range, I think. So that's our thoughts.
All right, thank you. Katelyn, any thoughts? I know the beef cattle inventory is down, and you see that reflected in beef prices. Talk a little bit about what you're seeing from some of the other competing proteins, and maybe anything that you're seeing from the export side, Katelyn.
So we're in a pretty unique environment right now where I think at the retail level, most of the prices across all animal proteins are fairly high, at least from a historical perspective. And that comes with good and bad. That means there's probably pork prices at the retail level can go higher just because beef and lamb are so much higher, as well as, if you think about what the price of eggs are today, if you put that on a per pound basis, that's more expensive than chicken right now if you make that adjustment on the weight. And so there's some interesting aspects of that. Now, there has been, I guess, a little bit of question from our mind about what is happening with pork demand, at least domestically. Beef demand has been phenomenal, and it does seem like we're not quite seeing the pork demand that we had seen in previous years, not quite as strong, at least for now. Now, we are heading into grilling season, which is usually an excellent animal protein demand time of year. But we haven't seen the wholesale prices really pick up, at least on the pork side, ahead of Memorial Day. Now, it might be a little early. We're not, those things can still happen, but beef prices have remained fairly elevated. We did see cash cattle prices back off a little bit here recently, but in general, it seems like people continue to buy meat, and they might be making some swaps there in the meat case, depending on preferences. And it does seem like things maybe have changed a little bit, but that could be more of a relative price comparison than a permanent shift. Now, on the export side, I don't think we're quite as optimistic maybe as some of the numbers Steve attributed to other shops. We're optimistic. We have exports above a year ago, but we're probably a little bit more concerned just globally and macroeconomically. These bank collapses that have been in the media, the Federal Reserve, signaling that possibly we aren't going to have any more rate increases and what that might mean for inflation or the dollar. I think we're still in a very uncertain time, both from a global macroeconomic perspective as well as a U.S. perspective. Now, I don't think the recession or a recession here might be as bad as some other places. And one of the bright spots, as Dr. Meyer mentioned, was Mexico last year. They're really projected to have fairly strong growth out there in 2023. And so that should be good for pork exports. Now on the beef side, we are expecting beef exports to pull back a little bit, but they've had 2 consecutive record high years. And so it's maybe not that shocking that we might not be able to go for a 3rd consecutive record high volume year on the export side.
Thanks, Katelyn. Yeah, I hope we're optimistic about grilling season. I know I'm headed up to our farm in South Dakota here this evening, and it is currently snowing in South Dakota and Nebraska. So I don't think we'll be on the grill here tonight. Well, I want to see, Altin, if you have any thoughts or comments on this as we start to wrap up our seminar for the March Hogs and Pigs report. Altin.
Yeah, I guess a couple of things. To your point on the grilling season, I think people are going to go out there and put some chops on the grill and buy butts and smoke them and all of that. I think that's going to happen. The challenge I think for the industry going into the summer is going to be what happens with bacon and the penetration that it has at food service, and the fact that the prices, whether it's at retail or food service, have reset at much higher levels than they were in the past. And so they're continuing to constrain some of the quantity demanded from the consumer end, but especially on the food service side, when you have 65-70% of the bacon or bellies, I guess, that are produced going into fast food, if they take it off their menu, if they're not promoting it for whatever reason, it's going to take a while. So I think we're dealing with some of the lagged impact from the high prices that we had last year. So I think that's a major challenge that we're going to have on the export front. I guess I'm agnostic. I can see both sides of it. There's some optimism that Mexico will continue to buy because their cost of production is much higher than ours, and so they can buy relatively inexpensive hams versus what they can make themselves. But they've tried to lower remove the tariffs on others and encourage some additional. But what Katelyn mentioned is real. We say that the U.S. consumer is struggling with inflation, and saying, well, it's costing so much more for us to buy food at the grocery store. And yet the United States only, I think our share of food spending as far as disposable income is, 6-7%. How about other parts of the world where it's 25, 30, 35%? It has an impact, and so that's where we're seeing some of the resistance. On the other side, and I think that's where the uncertainty comes from, is what's going on with African swine fever in Europe. And the fact that it's spread throughout Eastern Europe, with the fact that now you've got this cluster in northern Italy. Germany continues to find cases along their border with Poland, but also sometimes further in. And the question becomes whether it goes into France, whether it goes into Spain, and what impact it has on their export business. Right now, Spanish hog prices are up 50% higher than U.S. hog prices. So we should have some competitiveness in some of the Asian markets, Japan, South Korea, even China, with all the political issues. They're not going to shut their borders down. You look at what happened between China and Australia. They reacted, pretty strongly to some of the Australian, position, regarding COVID. But in the end, China continued to buy beef out of Australia, and was, I think, their 3rd largest market. So they're probably going to continue to buy from us. They're also very, they recognize prices and take advantage of price differences. So our thoughts are that exports are going to be up this year. But when I see some really bullish outlooks out there, I kind of take that with a little grain of salt. So that's all I have.
Yeah, thanks, Altin. Well, and as we wrap up here, you mentioned the European Union situation and the prices and African swine fever there in their what they would call their wild boar, we would call feral pigs. The Pork Checkoff did send over a team of veterinarians on with the USDA and producers last fall, and spent quite a bit of time in market there, really understanding what those lessons learned are out of the European Union, so we can be better prepared here in the U.S. And I'd probably close with one last comment and then some thanks. But the National Pork Board just did complete a major retail marketplace benchmarking survey of where we're at on quality and consistency with our product. And the news is really good. The product has really been improving year over year since we started this work over a decade ago. And with that in our back pocket now, the Checkoff is going to launch a major initiative around the pork loin, which we know has been undervalued, as some would say, as part of the pork cutout, as a really good quality eating experience. We're also got that active down in Latin America with U.S. Meat Export Federation as well. So as we wrap up here, I really would like to thank Altin and Katelyn, as well as Dr. Steve Meyer, for your participation and paying attention to everything in the U.S. pork industry. Our producers really appreciate it. So on behalf of the Pork Checkoff, wish all of you a really good, safe spring, those of you that are going in the field, and hope everything works well with you as you go into the summer grilling season. And we can cross our fingers for that. So thanks, everyone.